Well, everyone, welcome to the Smart Start Small Business Tax Tips webinar. We are excited to have David Mills here with us today to facilitate. For those of you who do not know David, he is a local CPA who specializes in small business accounting and taxes. So we are excited to have you here, David, and we are just going to
Okay.
turn the floor over to you.
All right, sounds good. Um, well, I think one of the things that starting out as far as with tax issues for the businesses would be, what's your business entity? So on the second slide there we go. There are several different choices that you can have. One is a sole proprietor, which is very popular. It's the easiest one to create and to report on. There's no legal protection though. So for example, if you're in a lawsuit or you have some other issues, any of your personal assets are at stake. There's single member LLCs and there's also multi-member and series and so on. A single member LLC, you have legal protection, but there's absolutely no tax advantage to it. Now, that doesn't mean that that isn't a good choice. For most businesses, I would, not giving legal advice, but I would like to see people use the LLC route to have some legal protection. And of course, you can consult your attorney on that. S corporation could make sense for people once they get above a certain profit level. I mentioned in there reasonable compensation issues. That means that if you have an S corporation, you are an employee. The owner is an employee of the company. And so one of the benefits of an S corporation can be paying yourself a reasonable salary. And then the excess profit is not subject to Social Security and Medicare taxes. Unlike a sole proprietor or a single member LLC, where you're going to pay your 15% Social Security and Medicare on all your earnings up to, I believe it's $167,000. So there can be some advantages. A C corporation, we don't see much anymore. It was very popular at one time. Double taxation is one of the main problems with a corporation, C corporation. You're taxed on any dividends, any distributions from the company. It could make sense to be a C corporation in limited situations. And then, of course, a partnership. So that would be two or more people. And we see that a lot with real estate. There certainly can be other issues or other situations where you'd like to have a partnership, meaning that maybe you have different types of entities that want to invest in your company. Maybe you want to restrict the sharing of profits in the company. A partnership could make sense at that point. One of the things that we run into, especially in the beginning, is your business, is it really a business? Is it being operated as a business, or is it really a hobby? The IRS makes a definite distinction as to that. They're going to look at profit motive. So for example, if you have many years of losses, you do run the risk of the IRS challenging that to see if you really are operating that as a business, or if you're just doing that to create losses to lower your income for the year. Many people ask, how can I audit proof my company? And the quick answer is, well, no, you really can't. There are some things that you can do to, in case you're audited, if you just happen to be extremely unlucky to be audited, then there are some things that you can do. first of all, keep separate bank accounts, credit card accounts. For a sole proprietor, um, sometimes we get a little bit of a pushback on that, but definitely for the LLCs and the corporations and the partnerships, you need to have separate accounts. Keep good records. Keep them for at least 7 years. The IRS and tax simplification in 2017, part of that simplification is you have to keep receipts. So in other words, if there's no receipt, there's no deduction. That's their idea of simplification. Now that doesn't mean you have to have the original receipt. You can scan those receipts, so you don't have to have boxes and boxes of paperwork that are there. Use QuickBooks, use a spreadsheet, have something that summarizes your income and expenses monthly, quarterly, and yearly. Because remember that the financials are a roadmap. I know many people think that the financials are just something they need for the tax return. And it's true that that's important, but the financials are a scorecard of how you're doing in your business. And it's going to give you good information as far as, when you start comparing year to date, if you have year to year, even if you have access to your industry numbers to see, are my cost of goods and my payroll, are those, in line with my industry? But keep your records up to date. That's the main thing. Okay, and then on the next one, yes, I'm always asked, do I have a complete list of what's deductible? No, I sure don't. That's because it's the IRS tax code, and I'm not being, smart about that. The IRS says an expense has to be ordinary and reasonable. Ask yourself the question, if I weren't in this business, would I have incurred this expense? And if you can say yes, it's because of my business, a high 90% of those expenses are going to be deductible in some way. Now, different industries have different levels of complexity. Like if you have a consulting business, you might only have maybe 10 to 15 expense accounts. If you're in a restaurant, something of that nature, you probably going to have 30 to 50 different expense accounts. So, when you're setting up your books, just, how do they help me make better decisions? I mean, yes, it's certainly, you need the good books for the tax return, but you need to be able to make good decisions during the year. Now, if you're audited, I absolutely guarantee you they're going to ask about meals and auto expenses, because those are the two areas that hardly anybody gets right. So with auto expenses, okay, the IRS says it's not enough to say, okay, it's January 29th and I traveled 32 miles to the bank and the post office. You need to have the date, the beginning and ending mileage, and the purpose of the trip. So that's why I recommend downloading an app on your phone. There are many of them. I just happen to use MileIQ because I have an iPhone. It records my mileage. I swipe right or left if it's a business or personal expense, and then I email myself my mileage report every month. So that's a good way for me. The meals, a couple years ago, meals were 100% deductible. They are no longer that. They are 50% deductible. and you need to show the business purpose of the meal. Okay. An exception would be, say, like if you had maybe a 4th of July outing for your employees, or if you do something at Christmas, something of that nature, then the meal can be 100% deductible on there. I know that we've had many people tell us that they've been told, or they're under the impression, that a home office deduction is an audit magnet. That's not true. The IRS has information on how to claim home office deductions. And so it probably works best if you're a Schedule C, a sole proprietor, and you don't have another principal place of business. That works out better. If you're an S corporation, it's possible to get a home office reimbursement, but you have to have what's called an accountable plan. We'll talk about that later, and it has to be reasonable. So it's still possible. Do you have children, your children working for you? If you're a sole proprietor, and the children are under the age of 18, there are certainly tax advantages there, such as not paying federal and state unemployment, and if they earn under a certain amount, I believe it's 15,000 in 2025, then they won't pay federal tax either. So that can be a good tax shifting strategy for those that are looking to pay less on there, and they're medium to high profit. Now, you can certainly be an S corporation, hire your children. Okay. We certainly have many of that. The IRS says they just have to do legitimate work. So in other words, you can't just pick a number out of the air and pay your kids that. Don't pay them once a year. Pay them on some type of a schedule. Maybe it's monthly, maybe it's seasonal, whatever it is. Don't do it once a year. Okay. The other thing is, again, if they earn under $15,000, they are not going to pay federal tax on that money. The other thing that's going to be good for them is they have W-2 income. They can have either a traditional IRA or a Roth IRA that they can contribute to up to $7,000. So let's say that, and now that contribution is the lesser of their earned income or $7,000. So if someone is paid $5,000, they can't contribute $7,000 to the IRA. It has to be $5,000. But think about what your children might be able to do around the business. Is it office work? Is it mailings? Is it cleaning? It could be any number of things that you have to pay for. One, kind of a little bit out of the box example was a few years ago, we had a person who wanted to use their child in one of their ad campaigns. So they called up an ad agency, asked how much the talent cost would be, and they used their own child, and they paid them the same amount. And that's perfectly legitimate. Some other things as far as with your company, think about it when you were an employee. Didn't you want benefits? Didn't you want health insurance? Didn't you want a retirement plan and some other things? So depending upon whether you're a sole proprietor, corporation, or whatever, certainly take a look at a retirement plan. That can be a pretty good cash savings or tax savings for you to do that. That would be through an investment person. Personally, we don't do those because we're not licensed for them, but we could certainly give you the names of very good people to work with on that. Depending upon your cash flow, that could be a huge benefit for your company. Okay, and then to the next one. You know, one of the comments that we always get is, I don't want to pay any tax. And the problem with that is, if you're profitable, you're going to pay taxes. The key is to pay the least amount that you legally owe, for many reasons. Okay, especially if you go to get a bank loan, if at some point you're applying for Social Security benefits, things of that nature. Quarterly tax estimates are normally needed for profitable businesses. Now, again, depending upon if you're an S Corp or a sole proprietor or so on, that varies. But typically, quarterly taxes are in April, June, September, and January. Typically on the 15th, unless it's a holiday or weekend. If you're an S corporation or partnership, your returns are due March 15th. You can get an extension filed for those. A Schedule C sole proprietor is included in your personal tax return, and that's due April 15th of 2025. Underpayment penalties can apply, so that's why you really need to take a look at what your profitability is. Some people will have their quarterly estimates prepared for them, and then they wait until January 15th to make the payment for the entire year. The IRS doesn't like that. They're going to charge you late payment fees. They say that, you know, their reasoning for that is, if you were a W-2 employee, you would have withholdings during your pay period. So we aren't going to wait for our money until January 15th for that. So that's why you can have penalties for that. A big area of conversation is employees versus subcontractors. Okay, the IRS always defaults to employees. And we're seeing that more and more, not from the IRS, but from the state. Illinois is conducting more and more audits of employees and subcontractors. And so why would you have a subcontractor? Because you don't have payroll taxes, and there's a significant savings if you have subcontractors. Okay, but there are certainly risks in there too. There is a big difference between an employee and a subcontractor. If you basically control their work, if you provide materials, if you provide an office space, if you provide training or licensing or any of those things, if you provide the tools to do the job, they are most likely employees. A subcontractor is someone that holds themselves out to do a certain type of work for many different companies or people. They will have their own insurance, which your workers' comp policy will ask for. So, you know, just be aware of that. If you have employees, the W-2s are due on the 31st to be mailed out, along with the tax forms. The 1099s for subcontractors, those are due to be sent out on the 31st. Another thing that we run into is, if you have a subcontractor, just get in the habit of, they have to complete Form W-9 before they get a check. That's absolutely important. I don't care if you don't think they're going to hit $600 or more in payments, get that Form W-9. We have several people during the year, every year, that will tell us, well, no, they wouldn't give it to me, they didn't do this, that, or the other, there are large fines per form for not having a tax ID, whether that's a social security number or a federal EIN. That starts at $550 per form. So make sure you get those first. Do your subcontractors have insurance? Again, your workers' comp audit's going to ask for that. Okay, so then for the next one, here are some things that are a little bit different. There's something called SALT tax, state and local tax, and that's different for corporations and partnerships than what it is for an individual. Okay, so basically what that allows an S corporation or a partnership to do, and this is for Illinois only, this is not for federal. For Illinois, the company can pay a total of 6.45% of their profit, not of their sales, of their profit. And this should be during the year too. And then what that's made up of is the Illinois individual tax of 4.95% and the Illinois replacement tax, which is 1.45%. Okay, so what that does is that payment is a deduction on your tax return, and it counts as an estimated tax payment for Illinois. So there's a double benefit there to do that. But those payments need to be made by 12/15, no later than 12/15 of the year. So for example, if you wanted to go back and make a payment this month for last year, it'll be deductible in 25, not in 24. And again, those are supposed to be set up on quarterly payments too. One of the things that just came out January 1st of this year, and you should have gotten multiple, well, you may have gotten multiple notices from Illinois, is a new sales tax. And so what that is that there's a sales tax requirement for personal property. So what that means is that if you rent land or a building or something of that nature, that's not personal property. That's real property. That's not included. So if you're collecting rent in some way, that does not apply. Okay, but let's say that, well, we just had this example this week, is that a contractor has a dumpster rental. Okay, well, that's personal property. So you should be charged sales tax for the rental of that dumpster. So, you know, it might be, now copiers are a little bit different, you know, because sometimes they call those leases, and many times those have sales tax already. But you just need to be, you know, unfortunately, there's not a lot of guidance from the state of Illinois right now on this requirement. But talk to your tax advisor, see if this is something that affects you. An accountable plan, you know, I mentioned that before. If you have a corporation, let's say an S corporation, and you have some home office expenses that you know, maybe there's some office supplies, maybe there's some other things. If you have an accountable plan, then, and basically this is just a document that is not in great length, but it explains what's going to be reimbursed. It also could be for your employees. So for example, let's say you wanted to reimburse them for cell phones or for home internet, anything of that nature that would be a reimbursement to them, that would be an accountable plan. One of the reasons why you would do that is because it's a deduction for the company and it's not taxable income to the individuals. So it's, it's at least worth looking into for that. Okay, and then on the next page, people still seem to be a little bit confused about the Illinois Paid Leave Act. That was in effect in 2024. It's certainly in effect in 2025. If you have employees, whether they're full-time or part-time, you are required to have employees accrue and pay for paid time off for any reason. Okay. It can be, I just want to be off today. And that's fine. It's up to 40 hours a year. Okay, so that means that a part-time person, most of our people, they'll have that accrue on how many hours they work. For example, I have seasonal people that work for me. I need to have them accrue their time off on, how many hours they work. Okay. And now an employer can deny the request for time off if they can prove a business purpose for it. You need to have that documented. You should also have a written paid time off policy that's been distributed to the employees. There's more information on that website. It's pretty good. It has a lot of frequently asked questions. It does a pretty good job. You as an employer can decide if you want to accrue or if you can front pay the amount. Certainly most of our people are accruing time. But then let's say that there was an amount of time that was due at the end of January or at the end of December. Are you going to roll that over? Are you going to pay a certain amount? Those are all things that you want to outline in there. Another thing that we have been asked a lot of questions of is the BOI, beneficial ownership information. Okay, that's been a political football. It seems to change about every week. At this date, the beneficial ownership report is not required. That could change. The courts are still deciding that. Basically, a beneficial ownership report means that if you're an LLC, if you're a corporation, a partnership, basically anything that you're registered with the state of Illinois, basically, you need to go to this website, and it is free. Okay, there's no charge to file this. But basically, it just says who are the owners, where do they live. There's a photo ID certification in there. It's the one thing that we say is that if you do a Google search for BOI, the ones that charge you for it are going to come up first. You need to look for this specific website, and it is free because that's the government website. But at this point in time, it's not required. But we've not seen the end of it yet on there. One other thing that I wanted to touch on, and it's not on the slide, is tax planning for 2025. As you probably know, the tax code expires 12/31/25. So if nothing is done, it reverts back to the 2016 tax code. So that means that the tax brackets, like the difference in how much you pay in the, let's say the 12% bracket, is greatly reduced from what it is right now. So you could have the same income in 25 as you do in 26 and pay a lot more tax in 26 than you will this year. Now, really, everyone has a theory. Who knows what the final regulations are going to be? I don't think, and very few people think, that we're going back to 2016. But we really don't know what that is. Okay. So there's, it's going to be important to try to keep up on, not the daily, but once a bill is passed, and probably the earliest of that will be July from what we've seen so far, and more likely in the fall, then it'll be a better barometer of what people need to do. But how does that affect you? Well, in some ways, for example, let's say that you buy equipment. Well, you have a choice of immediately expensing it, within certain rules, or you can set up regular depreciation, which would be 5, 7, 10 years, whatever that might be for that particular piece of equipment. Well, does it make sense to take that immediate expense this year? Or if you're expecting your profitability to be higher in future years, then maybe it makes more sense to set that up on regular depreciation so that it lowers your income in future years. So, an immediate expensing isn't always the answer. I mean, it could be a good answer for today, but it may not be the overall best answer for you. So there, and then there are other things that would be more on the personal side. So, for example, the federal exemption for gift tax will probably be different. And so, how does that affect you on the personal side? So there are a number of things that could change. Quite a few things are set for expiration in 25 that will have to be included in 26. So there are many things that we're used to right now as deductions that could be gone in 26. Again, we have to wait until Congress decides, but what's that new tax bill going to look like in there? Okay, and one last thing here. We're seeing more and more people that are selling over the internet, which obviously makes sense. Are you collecting sales tax on those purchases? Right now there, as 50 states, there's probably 20 to 30 different rules out there in the states. There's probably about 20 to 25 that follow a certain rule as far as number of transactions and dollar amounts. And then there are other states that don't. Chicago has a different tax structure than the rest of Illinois. Do you need to charge sales tax where your location is or where you're selling it at? So, for example, if you go to craft shows and things of that nature and you're selling there, then you're subject to, in Illinois, you're subject to the tax rate of that particular town. So you need to know that. Basically, what I'm saying is it's probably worth having a software company like Avalara. Avalara software has been doing sales tax forever, and they're a good company. I don't know their fees, but some states require a registered agent to be in that state. And so that's probably hard or not possible for many people. Avalara can take care of that. So it's just something to look into.